Thank you very much for the invitation, and congratulations to FESE to organize such an impressive conference in Prague. I would have loved to be personally in this beautiful city, but unfortunately I can only attend virtually. Nevertheless, I'm very honored to give you the opening address today. And let me start by introducing Better Finance. We are the European Federation of Investors and Financial Services Users, and hereby represent more than 4 million retail investors, including individual and small shareholders, fund investors, savers, pension fund participants, and also life insurance policyholders. The idea for a union of capital markets was proposed more than 7 years ago in the President's report as one of the pillars to complete the economic and monetary union. The first Capital Markets Union Action Plan was rolled out by the European Commission in 2015 and included a list of 33 ambitious objectives that would strengthen the link between savings and growth. Unfortunately, ladies and gentlemen, 7 years and 6 high-level reports later, Europe's capital markets are not further than their status quo at the moment when the CMU action plan was launched. As the name of this conference suggests, swift action is needed to unleash the potential of our capital market ecosystem in order to attract more citizens to invest in the real economy and in conditions of transparency and market efficiency. Let us look at the current challenges. We see the war against Ukraine, rising energy and food prices, and high inflation rates, just to name a few of them. The main question today is, how can we make Europe's economic base more resilient, competitive, and fit for the green and the digital transitions? To reach these goals, we need, first of all, a well-functioning capital market union. Therefore, it is essential that EU capital markets become more efficient and allow companies to access more diverse sources of funding, notably equity funding. Ladies and gentlemen, I think it is grotesque to see that investors in Europe are forced to manage 27 separate different withholding tax procedures, and the same is true in the case of exercising the rights of shareholders across Europe. We cannot ask investors to buy European equity if we are not even able to establish a level playing field within the EU, which means no more barriers between the individual markets in the EU, especially for the retail investor. And to be honest, the huge transformation which is in front of us, the green and the digital one, cannot be done without the retail investor. And to start with, the optimal allocation of household savings to finance growth, jobs, and sustainability cannot be done without transparent and well-functioning market structures. So, from a retail investor's point of view, stock exchanges enable them to securely and rapidly sell or buy an asset at a fair price, and this is called price formation. I think this is very important because it results also in the publicity of the pre- and post-trade data in real time, or at least as close as possible to real time. This is even more important now as research points to an increased appetite for non-professional savers for direct investments, such as listed shares and bonds. At the same time, the so-called do-it-yourself investing is on the rise due to the new fintech models, which brings capital markets closer and more accessible to the average saver. As such, I wish to bring my contribution for today's debates by presenting where retail investors fit in the current landscape, what can be done, to ensure that investing and trading is fair and attractive for retail investors? And what are the latter's views on payments for order flow? First, I will set the scene and present you a few details from Better Finance's research on the new retail investing environment and why retail investors and market structures must be considered holistically. Then I will continue by giving you a bit of insight on retail investors' experience with trade data transparency, what our mystery shopping concluded, what are the policy recommendations, and what can be improved. Most interesting, probably for this audience, I will touch upon the topic of consolidated tape. Further, I will speak about payments for order flow and the wider context of inducements. Given it has become a hot topic of debate and it divided stakeholders and decision makers across the EU, I wish to present you that the voice of European savers and investors has to bring this to the discussion. I will conclude my address with a few remarks on where we are and where we should have been and what can be done to correct this situation in the near future. To begin with, ladies and gentlemen, the developments observed throughout the COVID-19 pandemic, namely a large wave of previously inactive savers started investing, receive far too less attention than it should. We noted a steady decoupling of EU households from capital markets in the past 40 years, as they were slowly being driven away through passive packaged investment products. Now, EU households hold a mere 6% of their financial savings in listed shares and bonds. If anything, this is clearly unhealthy as it deprives the EU capital markets of a large pool of stable liquidity. Second, the initial surge in retail investments was felt on regulated markets. Reports from the French, Belgian, Polish, Romanian, or Danish stock exchanges showed a significant increase in the number of trades, which, coupled with a relatively small volume and value, is suggestive of a marked retail presence. This brought about two important effects. First, it cushioned the drop in equity indices during the first quarters of the pandemic. And second, it contributed to reaching historical highs in the market capitalization of EU-listed companies. In fact, academic research shows that retail investors tend to curb the illiquidity curve during phases of market turmoil due to their contrarian nature, which is another reason why unleashing Europe's capital markets must start by considering the needs and the interests of the retail sector. We should not forget the retail investor still is and will stay an important stabilizer of the capital markets. Now, the development of new business models, especially those integrating technology and digitalization in traditional financial services, has brought about positive effects. We should not forget about that. Most notably, it appealed to the younger generation of investors and attracted peers to open brokerage accounts and invest in shares, bonds, or listed exchange-traded funds. Besides a step in the right direction, from a financial planning point of view, it also provides non-professional savers with direct exposure to capital markets, which is a unique tool for financial education. The so-called neo-brokers allow savers to easily open brokerage accounts via the smartphone, see bid and ask quotes, and trade securities on Europe's regulated exchanges. However, there are two prerequisites for delivering an optimal experience and result for non-professional investors. First, transparency of equity and bond trading. And second, accessibility and user-friendliness of delayed market data. In our mystery shopping report, conducted by Better Finance in 2021, we observed first that the transparent EU-based regulated markets have seen their share of European equity trading declining from about 70 to only 18% by 2019. This was partly due to MiFID II, which backfired and made the EU the hub for dark pools and systematic internalizers, SIs. From about 14 SIs registered in 2017, the number of SIs took off after the entry into force of MiFID. A very critical development that we observe since then. Currently, ESMA registers show a total of 186 SIs active in the EU27. SIs benefit of several exemptions and waivers, notably on trade transparency. At the same time, Better Finance aimed to replicate the experience of the average retail investor when seeking pre- and post-trade data for listed equities. At the time, the findings were suboptimal as just a few of Europe's largest execution venues by volume fulfilled all the requirements imposed by MiFID II and MiFIR. While no changes were done at EU level, some of the market operators surveyed in the report did bring improvements to the manner in which delayed trade data is presented, making it easier for the average retail investor to find bid-ask quotes and prices at which orders are executed. Among the recommendations put forward to improve the status quo, Better Finance included two. One on European consolidated tape and another one for systemic internalizers. To ensure that investors enjoy optimal outcomes, EU capital markets must foster adequate price discovery and formation mechanisms, which can only happen through lit trading of retail orders, regulated markets, and lit multilateral trading facilities, MTFs. Retail investors must easily access pre- and post-trade data to be able to make informed trading decisions and also evaluate best execution on their orders. In practical terms, this translates to a consolidated tape that allows ex post verification of obtained prices and best execution deals by investors. What matters for us is that individual investors can ex post easily and freely check whether their order have been executed in the best of their interests. Therefore, all retail orders must be precisely time-stamped, traceable, and include information on the precise market venue on which the order was executed. Our proposals for the consolidated tape, I just would like to summarize them in short. First of all, to start with the bond markets. Secondly, to ensure that the consolidated tape does not distort competition in favor of opaque, non-transparent venues. Third point, to increase transparent trading in the EU. Fourth point, to reduce further market fragmentations and to avoid retail flows to go to SIs. Finally, we also want to make sure that the consolidated tape is freely accessible in a user-friendly way to retail investors. This bridges my address to you today to another highly debated topic, that of payments for order flow. Last year, EU authorities started the review of the main instrument regulating market structures at EU level, the MiFIR, the Markets in Financial Instruments Regulation, which I'm sure is on all of your minds. Sparked by the GameStop and the AMC cases in the US, the practice of PFOF, as we call it, was steadily uncovered as creating many challenges and posing many risks, also to the detriment of retail investors. PFOF were the backbone of new brokerage business models that proposed user-friendly, low-cost trading for non-professional users. Better Finance looked at the revamped business models that attempt to put the retail investor more in charge, to which we generally refer to as neo-brokers. The latter have become very popular for the low fees, sometimes even zero commission, services accompanied by direct access to a wide range of securities and to a do-it-yourself investing. However, ladies and gentlemen, the question we all seek to answer is whether PFOF is really beneficial or not to the retail investors. We looked at available evidence, including qualitative and quantitative data. Unfortunately, our key findings are that PFOF can create the illusion of free trading as it hides implicit costs, leads to conflicts of interest over best execution, can distort competition, and ultimately trigger an overall price deterioration for all investors. After all, even neo-brokers need a well-functioning business model which has to make profits one day. Retail trading must be simple, transparent, cost-efficient, and done in the best possible conditions for individual, non-professional investors. Our most important concern is that PFOF create a conflict of interest between the brokers and the SIs, which is definitely not in the best interests of the clients. While the best solution firmly remains a straightforward ban on inducements, including PFOF, certain alternative solutions can be looked at in order to deliver a high standard of investor protection and ensure that retail clients are delivered the best outcome. Let me conclude, ladies and gentlemen. Investors' trust is an essential condition for their participation in capital markets, and to build such trust, transparency is key. Today, we know that retail investors are stable shareholders that induce long-term sustainable capital. This contributes to favorable conditions for IPOs in the primary market, as well as for the company's onwards life on the secondary markets. By all means, the EU's economy and its capital markets are facing challenging times, and the long-term and stable funding source of EU households will be desperately needed more than ever to bridge this phase. At the same time, EU savers need more retail investments to hedge for future financial needs and to ensure that their savings yield better results, especially in times of high inflation rates. To maintain the current large wave of investors into EU capital markets, the young ones, but also to motivate their peers and future generations to invest, the EU needs to deliver an investing ecosystem that is fair, cost-efficient, transparent, and ultimately attractive for non-professional savers. As mentioned at the very beginning of my address, a lot of time has passed and many reports or action plans have been proposed and revamped in order to build the Capital Markets Union. Unfortunately, at least that's my view, the results so far have been suboptimal, which should prompt us to consider direct, firm decisions that will shape for the better. I do hope for our union and its capital markets for the next decades to come. So, thank you very much for listening to my speech. Thank you for your patience. I wish you all an inspiring conference today, and I'm sure it will be most successful and interesting. Thank you, Rainer.
Well, thank you very much, Jella, and I think